Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. The Federal Reserve has left its benchmark rate unchanged, as we saw yesterday. Fed Chair Jerome Powell stated that Trump's tariffs threaten to slow the U.S. growth story. During the press conference, Powell said that while we're getting close and closer to stabilizing prices, he said, I wouldn't say that we're at that now. Here today to discuss the Fed decision and what it means ultimately for inflation, for the global economy, is portfolio manager David Tulk. Great to see you, David. How are you?
I'm well. How are you?
Very well, thank you. Great to have you join us here a little bit. So we've seen interesting market reaction. There's always interesting market reaction after a Fed move or non-move. What did you make of inflation and then ultimately kind of the growth story that Jerome Powell was trying to enlighten us on?
Yeah, I think the Federal Reserve is trying to walk a very fine line and also try to stay out of the headlines as much as they can, just given the wider political environment that they are trying to navigate. So, in deciding to keep interest rates unchanged, I mean that was again very much baked into the market consensus. But as you noted in the introduction, I mean there was a very interesting dynamic between how their forecast evolved because if you really think about the tariff shock, and to be clear, the Fed is in the same boat as the rest of us, where we really don't have much in the way of clarity in terms of what's going to happen when and how long is it going to last. But you think of the sort of the essence of some type of tariff shock, and it would ultimately, again, push prices higher and weigh on growth. So that's one of the most difficult environments for a central bank to operate in, which is one of stagflation. So you can see the market trying to at least maybe key off of the fact that the committee still is expecting some rate cuts over the course of this year. But I think there's also an element to say that that statement could have been interpreted somewhat hawkishly because they do acknowledge that there is some inflationary risk that still exists. So you try to net those out, and probably the appropriate thing was to do really nothing at all, and that is basically what the Fed tried to accomplish.
I mean, when you look at some of the ways that we're watching the growth story, obviously the labor component comes back into everything. The Fed has a dual mandate. How much more closely did you think that consumer labor was coming more to the fore? I think we could say the page was turned a little bit on inflation even weeks ago. It was more about labor, but how would you net that out now?
Yeah, I think if you're worried about the tariff risk and a lot of the other political uncertainty hurting the US economy, it's ultimately going to show up in the labor market. And I think that is something that we've seen. It's a longer term trend, I would say, where there is some softening taking place in the US. It's not at risk of falling into recession, as best we can tell. There was some alarming, at least data with the Atlanta Fed releases a now tracker that takes basically recently released economic data and tries to project where the economy is going based on that. And they have one for the first quarter, which hasn't been formally released. So they're trying to just extrapolate data trends. And it showed a very precipitous decline in economic activity. But if you kind of dig into that, I think what that's showing is that there is a fair bit of importing taking place within the US as companies try to get ahead of prospective tariff risks. And there's a lag between when those imports are counted to when they maybe typically show up in a firm's inventory. So I think if you try to just see through the timing mismatch of imports versus inventory accumulation, that probably overstates some of the decline in that indicator. So that gives us a bit of confidence that, again, the recession risk and the labor market risk may not be as acute as what that one indicator might indicate. But then there's also a lot of the soft data, a lot of the survey data. So we see this from the University of Michigan, we see it from other sources as well. And not surprisingly, I mean, consumers are very uncertain about the future, both within the context of the U.S., but as they see conditions more broadly around the world, as they're trying to navigate the political environment as well. So there's always that I guess focus you need to have where you get survey data, soft data that slows, but it doesn't necessarily have a high correlation to actual activity data. So people can say they're very worried about it, but they're still going out there and spending and feeling good, or at least maybe not feeling good, but acting as if things are okay because, again, consumers will typically still consume. So we're trying to triangulate, I guess, some of the softer data that is showing weakness with some of the harder data that generally, again, through our lens, is not showing much in the way of a precipitous decline in U.S. economic activity.
So that's so interesting because there are voices and discussions in the market talking about how the tariffs, political uncertainty, I mean, we're living it, but also a slightly longer term creeping growth story that has been going on for the US economy. Maybe something to do with, the sort of out of the gates after the pandemic, lots of spending, and maybe just slowing that down now. Is that, again, it sounds like it's not something that you're concerned about, but.
Yeah, I mean, I think we've certainly seen the ebb and flow of consumer spending coming out of the pandemic. And there's also, I mean, still good news stories under the surface. So the AI story, the productivity tailwind that is benefiting the US, I mean, that's still there. But I think, the political dynamic is one that's creating a little bit more uncertainty because it's also, not surprisingly, delaying decisions. So as you're trying to wait for the policy landscape to make itself clear, and kicking the can down the road with tariffs is especially challenging in this environment. But basically, I mean, firms are trying to hold off on making any major decisions. And that can take place for a while, but at some point, you're going to have to make a call. And whether that call is one of continued confidence or, potentially pulling back, that's really what we're waiting for. So that's the type of evolution in the economy that I think we need to be very, very mindful of as we make investment decisions.
Okay, and we'll get to some of the investment decisions that you're making in just a second. Transitory was mentioned. Much has been made of this because it is a term that Jerome Powell sort of didn't have to say, but he said it. And this is relating ultimately to kind of a transitory or one-time price hike, price shock because of tariffs, the things that are coming into the country, imports that will suddenly be much more expensive due to the tariff story. And he's seeing that as transitory and not sort of an ongoing story. What do you agree with that?
Yeah, I mean, certainly transitory is a bit of a sketchy word in the world of central banking because they really applied that to the post-pandemic period and it proved to be anything but transitory. But I think, this time around, when you look at a tariff shock, if it is a one-time increase in prices, that will by definition be transitory as it falls out of the inflation data 1 year hence. But you also then have to maybe overlay, any kind of reciprocal tariffs or retaliation from other countries, because if you get into a tit for tat type of trade war and you're now increasing additional tariffs, and then that extends the period over which the price increase will show up in both inflation as well as in the level of prices. So, I think that's something that when you think of it as a risk, I think it has the potential to be transitory, but we have to be mindful that if this is a prolonged period of tariff negotiations with adjustments and additional sources of uncertainty, then it may actually end up being a little bit more of a lasting inflation shock. So I can understand why central banks, especially the Fed, can use that term again, because if there is one thing that central banks are really good at, it's fighting the last war. So the last war was the COVID response and the stagflationary supply side of the economy that they needed to spend a lot more time thinking about. Undoubtedly, they have thought a lot more about the supply side of the economy and arguably are better able to sort of really see through the tariff shock and make that determination. But yeah, again, it really does come back to these unfortunate unknowables in terms of what the tariff profile looks like and what other countries do in response.
And they're just bigger this time around. And again, so maybe part of the pandemic response is a bit of a playbook, or it's useful. But even if you go back to the tariffs, kind of before, there were some on Canada, obviously, but China sort of took the brunt in Trump 1.0. There's just way more tariffs being threatened to be handed out kind of across the globe this time.
Yeah, no, absolutely. And this is very different. And we can go back to the Trump 1.0 administration, and you definitely saw tariffs, even those applied to Canada as well, in the context of renegotiating NAFTA and the USMCA. But what you're seeing now, I think, more holistically, and this maybe gets at some of the motivation, is that I think when you have the economic advantage that the US does in terms of being a large, generally closed economy, that, yeah, tariffs will hurt your economy, but it will hurt other economies more. So you have some sort of exorbitant privilege, or at least a comparative advantage that you can exploit. and tariffs are the tool to do that. And we're seeing tariffs aren't just purely for economic reasons, but they're starting to filter into lots of other motivations. And it sort of reminds me of the phrase that when all you have is a hammer, in this case tariffs, then everything looks like a nail. And that's really, I think, what the administration is trying to target, to motivate a whole pile of different responses on a whole host of different issues, but primarily using the tariff lever as a way to take advantage of the position that the US is in currently.
Let's sort of put it all together with what the Bank of Canada has done and the position that they're in. We saw them cut. We sort of knew they were going to. Some people called it a bit of an insurance cut, waiting for more news on tariffs. It leaves the differential wider between the two. What do you think it leaves Canada with, this rate move, but just sort of this environment, short term, long term pain? We don't know.
Right. Yeah, and unfortunately, I mean, you probably won't be surprised to hear me say this, but it probably will be both short and long-term pain when it comes to the outlook for Canada at this stage. So going back to the Bank of Canada's decision, I mean, they made this very clear that the cut that they made was in response to the risk around tariffs. And if the tariff risk continues to be there, I wouldn't be surprised for them to continue to cut to just bolster that insurance policy, because it really just comes down to the notion, and in stark contrast to the United States, of how important trade is for Canada relative to the US. And as we know, it's a huge portion of our economy. It's much less so for the United States. So whereas the Bank of Canada, as they go through that same type of stagflationary environment, they know that they will see some higher inflation as a result of tariffs, but the hit to the growth side of the economy is likely to be an order of magnitude larger. So in figuring out which one you want to try to balance, you don't really have that luxury in Canada. You really have to respond exclusively to the growth shock. So that's the interest rate cutting cycle that, again, could continue from here. And that interest rate differential that emerges as a result of that, I mean, that is something that typically will cause the Canadian dollar to depreciate. And that's actually something the Bank of Canada probably won't say publicly, but probably something they feel is really important, because it helps to rebalance the economy and it helps to offset the hit to competitiveness that comes from a tariff. So if you have a 25% tariff placed on your exports and your currency falls by 25%, just to use broad numbers, then that neutralizes the impact in terms of the competitiveness for your importers. So that's part of the adjustment mechanism. That's something that the Bank of Canada thinks of as their contribution to helping to reinforce the Canadian economy against this trade shock.
Do you think that, I mean, there's a little bit of a fire that's been lit under Canada to get moving on things that it hasn't, policy-wise, gotten cracking on for decades and decades, but it's been talked about. There is that momentum now. If the tariff threat went away in 3 months, would we lose all that momentum, for instance?
Yeah, this is an opportunity, certainly. And this is an opportunity for Canada to really address some of these long-term challenges, to knock down interprovincial barriers, to think about diversifying trade. So I do think that a crisis is a horrible thing to waste, in the sense that if progress really isn't made in that direction, then we've lost that opportunity to make those investments. And the cynical side of me perhaps thinks that if we do get some sort of negotiation on tariffs, where there are some, but maybe not as bad as what people feared, it'll take some of the pressure off to do the real hard work in terms of that larger diversification story. And I think that ultimately comes to the disadvantage of Canada in the long term. And it might, again, soften some of the shorter term blow, but this is something that as a nation, I think we need to spend a lot of time looking in the mirror and thinking about having a more diversified trade strategy and growing more in an east-west fashion, as opposed to the north-south relationship that we've benefited from for decades.
Yeah, it's a fascinating time. It really is. We're going to get to your positioning. Just a couple of questions on the 10-year yield, which has been fascinating to watch. I mean, we were all sort of bubbled over with, oh my goodness, it's going to, go over 5% or sit at 5%, or and here it is down. I mean, at one point, I think it was at 4.17 today. So it's really come off. Tell us a bit about that action, and to what extent perhaps the administration might be happy about that.
Yeah, I think, we've heard this out of the Treasury Secretary in the United States, that instead of trying to maybe target a stock market return or result or level, they're more focused on the level of interest rates. And part of that, I think, is a nod to helping to inspire the bigger part of the U.S. economy. Anyone that has a mortgage or is otherwise interest rate sensitive, if you can lower interest rates, that's a net positive into rate sensitive borrowers within the U.S. But it's also something I think the U.S., at least on the Treasury side, is mindful of, is that they're running huge deficits, and they hope that this tariff revenue will be able to at least reduce those. But ultimately, they need to be very mindful of the cost of borrowing. And if they can be successful, and again, it's a very open question, if they can be successful in talking down the 10-year yield, they reduce their carrying cost of the debt that they're running right now. So they have a strong incentive to try and do that just out of their own self-interest so that they don't face exorbitant borrowing rates in the wider market. And I think the bond market is somewhat aware of that, certainly. And as they're trying to kind of find the balance between the inflationary consequences of tariffs versus the hit to growth, it seems that they are a little bit, maybe rightly or wrongly, focused on the growth side. So that's why you've seen yields come down. But just I would take that step back and say I wouldn't be too optimistic and expecting that decline in interest rates to go down, because that stagflationary side in terms of the inflation part, again, isn't entirely out of the system yet. So the Fed, I don't think, will be able to deliver the same degree of rate cuts as those bond investors are hoping for today.
Okay, that's really interesting. There's a question about that. If you think the Fed or the market is reacting a little bit too optimistically from the Fed decision. One other one, just before we get into positioning, why have tariffs, David, imposed by other countries on the U.S., similar to the 240% by Canada on dairy, for instance, not created the same market uncertainty? I don't know, maybe it has. What do you think?
I think that's a good question, because I think what we're seeing is really an opportunity for the market to look through the various countries, look through the various regions in the world, and try to understand who is more economically vulnerable. And again, the U.S. has that benefit of being relatively immune to the tariff risk, and whereas other countries in other regions around the world, I think, face larger concerns. But it's also, I think, important to take a step back and understand that, yes, the tariff story is a big one and certainly driving a lot of what we're focused on, but there are tons of other things going on as well within the U.S. The administration is moving in the U.S. very quickly to do a lot of different things within their country, and I think investors are mindful of some of those consequences too. So there is still attention paid on the future of tax cuts in the United States, the debt ceiling, and all of these other issues that are still out there that I think can drive markets. So I think that probably helps to explain some of the differential impacts. And then I also would think about how the market is moving in response to a lot of this stuff. I mean, if you want to be invested, you're going to have to choose between some of these markets. So it's not just an absolute answer in terms of saying yes or no. It's more a case of relativism. So, if the story in Europe or elsewhere is maybe marginally better than it was 3 months ago, but still objectively not great, then that can pull a lot of capital in. And I think that's part of the dynamic that we've seen certainly over the last couple of months.
Speaking of capital, let's talk a little bit about the positioning actually that you've had, and you and your team have telegraphed it well, an overweight to U.S. equities sort of in the past. It's changed somewhat now. Bring us up to date a little bit.
Yeah, so we have a new thought leadership piece that actually came out this morning, so I hope everyone has a chance to go through it. And it really outlines a lot of the motivation behind some of the admittedly fairly large changes that we've made to our allocations around the world. And to just take a quick step back, and I think as we go through a lot of these headlines, and one of the things that we have really counseled is not to overreact to the headlines and try your best to see through a lot of the volatility. But as an asset manager, you also don't want to underreact either. So when things do change, and we spend a lot of time working with our researchers and understanding this environment so that we have confidence that if things have changed, we do have to update and change our positioning and be flexible in this type of market. And that's the operation that we're taking. And then the theme or the thesis really is that the U.S., as we know, had been priced for pretty much continued exceptionalism. That was where the growth was. Even if the market in the U.S. was expensive, there were parts of it that we saw an opportunity in terms of a relative value. That's where the earnings activity was. And that was very much something that motivated the overweight we had into the US. Now, as we learn more about the current administration, it seems that there are lots of things that are challenging that theory of continued exceptionalism. And we're very mindful of that. And as a result, what we have started to do in pretty sizable fashion is to reduce the overweight that we have into the US market and instead allocating in larger fashion to Europe, into Japan, into emerging markets, because not only is the US potentially challenging their exceptionalism story, but you're beginning to see some signs of positive activity emerging out of Europe. So in the same way that we talked earlier about, is this an opportunity to try to address long-term structural issues, there does seem to be some indication that that is happening in the context of Europe. So we have, Germany spending a lot more money, not just on defense, but a very large sort of fiscal package as well. And we've started to see some of these flows move in that direction. So what we have done in the portfolios is to really rotate the overweight we have out of the US more towards these other regions around the world. And then the second part of the positioning that we've done is to, first off, acknowledge that there is a lot more uncertainty, and there's always uncertainty in the market. That's inevitable, but I think it's fair to say that there's a little bit more than usual. So we are trying to take down our risk posture somewhat, so a little bit of a smaller overall overweight into equities. And what we're also mindful of in that becoming more defensive is recognizing that this is a stagflationary shock, so we've been adding more into inflation protection. So in the form of tips in the United States, as well as a little bit more gold, just to give us that additional hedge against the longer term consequences of tariffs. So those are the two main thrusts in how we've evolved our positioning.
You've mentioned that, as you say, Europe also, in a way, has had to get moving on things that maybe it had been thinking about for some time, and switch gears a bit, just like Canada. Will the Canadian dollar at some point be so low that it actually looks good?
I mean, that's always the answer that we would think of, or what we would look for to have a more constructive view on Canada. So at the right price, there's absolutely a compelling story to increase our allocation into Canada. I don't think we've necessarily seen that. So it's an interesting story, because as we sort of thought about the evolution of this argument, before Europe really seemed to get its act together, we thought that Canada might be viewed, and I've used this line many times, as a bad house in a good neighborhood, in the sense that they would benefit from the continuation of US exceptionalism. So that story, I think, unfortunately has gone away. So if you're a global investor and you're thinking about Canada that has this larger economic exposure to the US and the tariff risk, or you contrast that to Europe that not only is a little bit more insulated from some of these tariffs, but is actually developing organic growth domestically, I think you start to go there. So as we've made these adjustments, we really haven't changed our underweight into Canada. So we're still very much cautious on Canada. It's also a helpful reminder to know that there's still challenges that exist within Canada's domestic economy in terms of a lack of productivity growth, as well as challenges with housing that are still, festering in the background that we seem to have sort of pushed to the back burner.
There's a question on that. Can I ask you to just add it in right there? Just this, yeah. Do you think, what will overall the interest rates and the backdrop story effect have on housing is the question?
Yeah, no, absolutely. I mean, I think of it as that mortgage wall that exists, as 5-year interest rate, 5-year mortgage rates that were originated in sort of the very low rates coming out of the pandemic. That still exists, and I think you could maybe make the argument that instead of a wall, it's now a speed bump, in the sense that rates have come down somewhat, but you're still at risk of tripping over that speed bump. So it still is an environment where households who are refinancing at much higher rates will face some challenges in terms of spending. So if the Bank of Canada were to continue to cut interest rates, and hoping and assuming that 5-year yields sort of fall in lockstep, and I think that's not a guarantee in any sense, but if that were to happen, then it does tend to at least alleviate some of the pain that I think Canadian borrowers will face, but it doesn't take it away, unless you're very negative and think that we're going back to COVID level interest rates, which again, as scary as a tariff shock is, it's a different type of shock that I think that going back to that that sort of level of policy stimulus is not likely to happen this time around.
Just bring us back to that idea of, you want to steady the ship, but you don't want to underreact as well. I mean, you make decisions with a lot of different pieces of information, but maybe just a bit more on how the team came to some of this new positioning.
Yeah, no, absolutely. So, we've got a process that incorporates a fair bit of top-down macro understanding of the world. So we've spent a lot of time with our asset allocation researchers to understand the wider business cycle and be in a position of evaluating the various policy initiatives that have been announced in Europe as well as those in the US. We have a very significant presence within Washington in terms of government relations folks, and I think some of them have appeared on Fidelity Connects recently as well. So they're helping give us a sense of the lay of the land and helping to, as best they can, try to handicap odds of different outcomes as well. So that's certainly part of the macro top-down overlay that goes into our decision-making process. But an area that I've talked about before that I think has been crucially important is really just getting as much company-level intelligence that is fed through our analysts and our building block portfolio managers. And they were really able to give credence to the theme of maybe Europe is actually turning a corner versus, in the US where there's just so much uncertainty, there's a lot of hand-sitting and not necessarily worry, but apprehension, I guess, is probably the right adjective to use. So that kind of went into the notion of saying that this rotation, could certainly have a little bit more to it. And then we also just, reference back to valuations. And again, valuations without a catalyst, can exist for quite some time. And we've long viewed the US as expensive, and we were happy to invest in the US knowing it was expensive because, again, there are other parts of the world were maybe cheap for a reason, and that the macro catalysts were all very positive behind that expensive US market. But if that policy uncertainty is at a level where you're not as confident in that theme of exceptionalism continuing, that can be the catalyst that sort of allows valuations to correct. And we've started to see that not just in our view of the world, but the market's starting to come up to that perspective as well. And then finally, we're also very mindful of flows and sentiment. And again, at least from a sentiment perspective, it was very much viewed that the US was priced for exceptionalism and the flows were quite obvious. And now that trend is starting to change somewhat as well. So, we want to be contrarian in terms of really excessive flows and shifts in sentiment, but at the same time, we have to be, respectful of the momentum that can exist in a market as well. So we've tried to calibrate all of those four different factors in terms of macro, bottom-up, valuation, and sentiment to feel comfortable in this type of shift in the market. And I should just note as well, and this is something that I said at the kickoff event at the beginning of the year, this is also the environment where you want to use liquid instruments. So we're trying to make use of our futures capability from an overlay perspective. We're trying to use ETFs where appropriate because this is a great environment for active managers who are using security selection, and they don't want us, or they don't need us right now tapping on their shoulder asking for big sums of money as we reposition these portfolios. We would rather try to use these liquid market instruments to let them find the opportunities, leverage the research, and bring that security selection into the portfolio and leave us to sort of tilt the overall beta orientation of the fund where we see as being appropriate.
That is absolutely fascinating. And I feel like you gave us so much more of exactly what you're doing and how you're doing this, and obviously why. David Tulk, it's such a pleasure to have you expand on what we just heard yesterday and how it filters through to so many different pieces of ultimately how you invest. All the best, and thanks for joining us.
My pleasure. Thank you.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.